Good morning and welcome to our not quite 10 minutes at not quite 10 o'clock. Today we are going to be talking about balance sheets and more importantly balance sheet ratios. What are they and how will they help us? So a balance sheet basically is a list of everything you owe and everything you own at any point in time. So when you're looking at your P&L and you're looking at your management accounts at the end of each month, you really should be looking at your balance sheet as well to make sure that everything makes sense in it. Are your assets and your liabilities all properly recorded? Does it make sense? Do you recognize the numbers? Is it showing you who you owe money to and who owes you money? So A, you can plan who you're going to pay, when, how and what with, and B, you're going to be able to chase all those people that owe you money to get the cash in to pay your own liabilities and of course to pay you. But today what we wanted to take a look at is some of the ratios that you can use, or some of the things that you should be looking at in your balance sheet, taking a little more of a deep dive into your balance sheet. So we think one of the most important things in your balance sheet is your director's loan account. It needs to be up to date. You need to include all of the drawings that the director has taken. You need to include all the spends that the director has paid by the business for things that belong to him. Include all business spends that are paid for by the director, but the business owes back to the director. Include your expenses, such as your work from home allowance, your mileage, and try and do this monthly so that this is all accurate and up to date. You should include net payroll. Well, sometimes you'd include net payroll. Some people run a business and they run themselves as a director on payroll, and then they will pay themselves the net pay that is owed as a director, and that goes out of the bank and it goes to your net wages payable account. So your wages owed versus your wages paid then nets off to zero. Whereas some people prefer to take their cash from the business in lump sums. So in that instance, it's more efficient to then run the net pay received by the director off over to the director's loan account to offset those drawings. So it won't ever match the fixed sums that are taken, but it goes some way towards reducing those balances down. Either way is fine. It's, horses for courses. You choose what works for you. Now, some clients that we work with have a director's loan account, and what they do in their balance sheet is they'll have a director's loan account which will show those big chunks of cash that are taken out, but they'll also have a separate director's expenses account. So this is money that the director has spent on behalf of the business and wants to be paid back at some point in time. Now, the advantage of keeping the loan account and the expenses account separate in our Xero or QuickBooks is simply because the expenses account is a reimbursement of cash owed. So there's no tax implication. And what some people do is, especially around sort of holiday times or Christmas times, they'll raise their expenses, they'll put them through the business, and then perhaps they'll draw them, in December, or they might draw them before the summer holiday. And they use them a little bit as like an impromptu savings account. The director's loan account is slightly different. The only way to reduce the director's loan account really is either to repay that money back into the business, as we know, or it's to declare dividends. So actually, how does this help you in terms of managing your profit? If you know what the dividends drawn, or if this is really cash in lieu of dividends, if you know how much you've drawn, which you need to offset by dividends at some point later in time, then you can use that figure to help forecast your sales, or more to the point, forecast your profits after tax on your sales. So then understand how much more you need to generate. Do you need to have a big event before the end of the year? Do you need to have a product drive before the end of the year in order to make enough profit to pay off your overdrawn director's loan account? Or are you sitting comfortably? You have lots of reserves either in the current year or in previous year that will pay off your director's loan account. one or the other. So if you understand what those figures are, how much you've drawn in terms of expenses and how much you've drawn in terms of your director's loan, it can help you plan your forecasting, help you plan and forecast your sales and manage your business to the end of your financial year to make sure you don't exit with an overdrawn director's loan account.
And on the topic of sitting comfortably, the next ratio we want to share with you is the current ratio. And this is a liquidity ratio, which measures the company's ability to pay off its short-term debt.
Yeah.
So it's measured by current assets divided by current liabilities. Sorry, annoying fly on my head. And by current assets, we mean items such as your bank balance, cash, trade receivables, stock, items such as this. And these are all things we can quickly convert into cash. Current liabilities are items such as short-term debts, such as overdrafts, credit cards, payables, and short-term loans, things which all actually need to be paid in the year. So anything with this ratio, the thing that we're looking for here is anything above 1 is a positive ratio.
Yeah.
Basically means you have more assets than liabilities, and it tells you how many times over you can cover your debts. So if it's 1.5, you can cover your debts once and then an extra 50% over. So why exactly is this ratio useful? Well, firstly, it helps you understand your risk. If the business stopped trading tomorrow, could you actually pay off all of your bills if you had to? If you took out an additional short-term loan, could you afford to cover it? And how exactly does this all interconnect in with profit? Basically, if you have a high current ratio, you have more wriggle room for your cash. So if you, we all want wriggle room. Basically, you have a little bit more flexibility, a little bit more contingency, a little bit more working capital probably, and this just gives you a little bit of it gives you just that little bit of breathing space. Really, you might be able to perhaps draw just that little bit more or invest that little bit more. Generally, people with high current ratios and high cash reserves could actually potentially be investing in growth in their business. So they could be putting the cash towards, say, marketing or new staff members and new products. So really the point to think about this one is, could you be generating more profit with that cash which you currently have sitting there? And this is often indicated by how high your current ratio is. High current ratio means, could you be utilizing your money more? Really key
that's
one.
Not necessarily the traditional way of looking at the current ratio, is it?
But
that's certainly a way that we can help use it in our own small businesses. Now, the really great news is that you don't have to go off and run away, try and work out what the current ratio is yourself. If you are a Xero user, Xero provides this number for you in a little known, often overlooked report called Business Performance. So if you go into the accounts directory, I think it's in accounting, in reports, and then in the first set of menus, the financial reports, there's a report called Business Performance. And what they have in there is about half a dozen, I think maybe about 10 different performance measures that you can be using to help measure your business. Now, the sum of all of those together is really helpful to make sure that you're always on an upwards trajectory. That's where you really want to be. So let's have a look at another ratio that's really handy to look at. So the debt ratio. The debt ratio looks at how much of your business is funded by debt. So it takes the debt balance and divides that by the current assets. And again, it provides a ratio figure. So it's useful to know, if you have a debt ratio of 60%, that's considered to be quite high. So if 60% of your assets are covered by debt, then if you had to repay that debt tomorrow, in theory, you'd lose 60% of your assets, or you'd have to liquidate 60% of your assets to pay that off. If you are over 60% or 60% and over in that category, then you're often considered to be high risk. So if you're looking for more funding or factoring or long-term loans, short-term loans, credit cards, that kind of thing, you're going to be considered higher risk. And it's either going to be very difficult or impossible for you to get additional debt funding if you need it, or it's going to be at a much higher rate because you're perceived to be that higher risk. Now, that in itself doesn't help somebody who's in business and is struggling to pay their bills. when debt becomes more and more expensive. So the more you need it, the more expensive it becomes, which is a real sort of supply and demand problem for the business owner, not for the lender, because it's great news for them. So if your ratios are between 40 to 60%, you're still towards the higher end, but it's the higher end of what's considered to be normal, certainly from an underwriting point of view. But could those debts be refinanced for more preferential rates? So the problem when you've got that level of debt in your business is that the interest charges are all going to be fixed. So regardless of whether you make a profit or a loss in that month, and whether you've got the cash to pay it or not, you still have to repay the capital and the interest on your loan, and it's still a debt burden, a cash burden on your business. So how does this help us manage profit? If you know that you are a high debt business, or you have debts that you're trying to pay down, then we don't need to be funding. We're going to try and avoid funding our business and growing our business by getting more debt. We need to be bootstrapping. We need to be generating more cash. So this helps you to focus your mind to generate more cash, have cash generating events, product launches, new sales, new marketing regimes, something to get high turnover, high cash generating transactions going through your books to try and reduce that debt and pay some of it off, thereby reducing your interest charges, thereby reducing the burden on both your P&L and your cash flow forecast.
The good thing about that debt is it lets you be proactive about it.
Yeah.
You don't have to get to the point where you apply for debt, you get rejected, and then all of a sudden you're like panicking, trying to rush around, trying to bootstrap. Then you can bootstrap in advance in preparation. And to be honest, it's good practice anyway. If you can bootstrap.
Think so. But one of the challenges that we see in a business, whenever businesses get into a cash flow slump, they often think, I must borrow, I must get debt, I must get a loan, I must get a credit card, and their focus is on paying their liabilities, not necessarily on generating new sales that are going to generate the cash that are going to allow them to not have to take out debt and not have to burden themselves even further. But sometimes the thought of creating a new product or talking to new clients and making new sales or generating the new income is more scary than trying to get debt to cover what you're already doing. And then they'll continue to do what they're already doing, and they'll continue to squeeze their margins, and they'll continue to take on more debt. So it just perpetuates the problem, when in reality what we need to be doing is stripping out the areas of the business that are not making cash, stripping out the non-profitable products, and changing these ratios in our business by restructuring the way we sell.
Yeah, makes a massive difference.
Yeah, but it's hard.
It is very difficult. Now, the last thing we are going to share with you today is the run rate. So basically,
not a traditional measure, but something that we think small businesses really need to be looking at, and something we look at quite frequently with our clients.
And this follows on quite well from the concept of loans and fixed costs.
Yeah.
So if you're taking a look at your fixed cost from your P&L, you'll have an average monthly expenditure, which may be comprised of items such as rent, rates, salaries, all costs which are physically required to keep the lights on in your business. So no matter what happens, you're going to have to pay those in a month if you continue to run. This tells you how many sales you need to generate in order to keep the lights on as well. So basically your break-even point. Now, there is actually another way to look at this, which puts the balance sheet spin on it. So basically, if you decided today that you were planning to take the next X months off, maybe a couple of months off, how long would your business reserves actually cover your operations for? Let's look at, say, if you have £50,000 worth of reserves. Pretty good position to be in, to be honest. If your balance sheet is actually in this position, but your fixed costs, say, 20,000 a month, you could keep the lights on for around 10 weeks. Now, this is the case even if you have, say, £150,000 sitting in the bank account, because you might actually have £80,000 worth of income which has been prepaid. So work you've been paid for in advance before it's being delivered.
That you might have to repay if you turn the lights off tomorrow.
Exactly. And of course, you might also have, say, £20,000 worth of unpaid taxes.
Which still need to be paid if you turn the lights off tomorrow.
So the net result is actually you only have £50,000 to cover you for the period. But that looking at the cash in the bank account can often distort that. So if you look at your balance sheet and you're looking at the equity line, this gives you a clear indication of your run rate, how many times over you could cover your fixed costs say how many months you could cover it for. Really important to know, because if you did decide to take time off as a business owner, you want to know it's kind of like your margin of safety in that perspective.
It
but
is,
not quite.
And it's really important to know how long that could happen, how much contingency you have there. So we've seen instances with some of our own clients and friends and people we know in the business where perhaps a family member has died and they've taken time out of their business to go and look after them, or to nurse a sick parent or something like that. People who've taken the summer off and they've gone traveling for 3 to 6 months, people who have had life-changing events, or perhaps they've fallen ill and then had to put their business on hold for 6 months. It's those that have staff can sometimes take over or even do quite well when the business owner's off. You might argue that some actually do better with the business owner not interfering. But it gives you that contingency. So one of the things that we often look at when we do create a board report for our clients is we look at the run rate and what happens if the lights turn. What would you need to do to keep the lights turned on if you left the business for X amount of time? So quite often what people want to do, and a common factor, is to try and keep 3 to 6 months worth of contingency in reserves, so that if something happened, you're covered for 6 months before you need to make decisions to come back to work, to reinvigorate the business, to go out and get a job, whatever those
things
alternatives
change.
might
It
be.
could be if you've got a really big client who operates as a large percentage of your portfolio. If they went pop tomorrow, you've got to think about these contingencies. You've got to have them in place. So it's not just about personal life; it's also about the business as well. But the profit in this,
it's managing risk,
is both.
isn't it? And it's managing your personal risk and your business risk, and making sure that you've got that contingency in place. So that's it for today. Thank you for joining us for our review of balance sheet ratios. If you enjoyed today's video, please let us know in the comments and we'll record more like this. And if you have any queries about this topic, please also add that in the comments. If you are watching the replay, please put hashtag replay in there so that we know who's live and who's replaying. Helps us again manage the right content for you. So we still owe you one more video, so we will do cash hopefully today. We've got a couple of clients that are coming in this afternoon, so hopefully we'll do our cash one today. If not, we'll be back twice tomorrow. So thank you for joining us, and goodbye for now.
Bye.
Bye. Hi, I'm Lisa.
And I'm Harry.
And we are Chartered Management Accountants from Caseron Cloud Accounting Limited.
If you enjoyed this video, please subscribe to our channel for more videos like this.
Click on the link below to join our free Bloody Brilliant Business Bookkeeping group on Facebook, where we are live every weekday answering questions, sharing stories and building profit-generating businesses that put more cash in your pocket.
If you want to learn more, or you want to take a deeper dive into any of the topics we have covered, join the Bloody Brilliant Business Club with tutorials, workbooks, cheat sheets and checklists which make it stupidly simple and brilliantly profitable to understand the financial stuff that you hate.
We'll see you there. Bye.
Bye.